Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Deere's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 105 billion market cap. They're trading at $3.80 a share, and they have 275 million shares outstanding. Deere & Company manufactures and distributes tractors, combines, cotton pickers, sugarcane harvesters, seeding equipment, sprayers, soil preparation machinery, and much, much more. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is flat from 2021 to the trailing 12 months. It dropped a lot in 2022. It looks like they invested into CapEx. It came up in 2023 and then up a little more in the trailing 12 months. But margins were much higher in 2021. Free cash flow margin 12%. Now it's 9%. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that grew a lot from 6 billion to 10 billion, down a little in the trailing 12 months. Margins look pretty good, 16%. I like to see net profit margin 20% or higher, but they're not too far off. Revenue is the sales for the company, and that peaks in 2023 at 60 billion, down 4% in the trailing 12 months. Their price of sales is 382 over 209, and they pay a decent dividend, 1.5%. It cost them 1.6 billion. They can cover that about 3 times. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 137 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $122 billion. We divide that by 275 million shares. And we get a calculated stock price of $4.40. They're trading at $3.80, so they're trading at a 14% discount. It's a buy according to the model. There are 27 companies in the same industry as Deere, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 2.7 billion. They are a bit leveraged. Their debt to equity ratio is 2.9. For every dollar of equity, they have $2.90 of debt. They pay a nice dividend, 1.5%. They generate a lot of free cash flow, second highest on this list. And they're a big company. The only company bigger is Caterpillar. Their PE is equal to the median. They're trading at 11 times earnings. Price to free cash flow is worse than the median average. Same thing with the price of sales. But they do generate a lot more revenue than Caterpillar relative to their market cap because they have a much better price sales ratio. And they are growing. Their 5-year annual revenue growth rate is 8%. If you put $10,000 into this company 10 years ago, you'd be pretty happy at $50,000 today. That's an 18% annual return, a 400% total return. Let's take a look at their income statement. This shows us the 3 months ending 4/28/2024. This is the 3 months ending 4/30/2023. And these 2 columns are the trailing 6 months. So revenue is down. It was 17 billion. It's 15.2 billion. Product sales 13.6 billion. Finance and interest income 1.4 billion. Let's see if they give more detail on the revenue. They break down their revenue in 4 segments. Production and precision 6.7 billion. Small agriculture and turf 3.3 billion. Construction and forestry 3.9 billion. And financial services 1.4 billion. They also break down the revenue by country, 9 billion US, 1.2 billion Canada, Western Europe, 1.9 billion, Central and Commonwealth Independent States, 450 million. CIS includes Russia, Kazakhstan, and a bunch of other countries. Latin America, 1.4 billion, Asia, Africa, Oceania, and Middle East, 1.1 billion. And they give a breakdown by major product lines. Production agriculture, 6.5 billion. Small agriculture, 2 billion. Turf, 1 billion. 1.7 billion to construction, 700 million of compact construction. Road building, 1 billion. Forestry, 270 million. Most of the time, revenue is recognized when the product is delivered or the service is performed. But sometimes it's overtime. And that's popular with construction contracts. If you have to build a home and charge the customer $1 million for the entire project, you might bill them in stages, maybe in 4 stages. When the home is 25% completed, you bill the customer $250,000. When it's 50% completed, you bill the second $250,000, and then 75% completed, then 100% completed. So you don't recognize revenue at one point in time. It's recognized over time, over a certain period of time. But in their case, it's mostly financial services are recognized over time. Here's their income statement with percentages. Revenue went down in the first 3 categories. It went up the most as a percentage in financial services. The operating profit in financial services went up the most, 400%, but their operating profit is down, $3.9 billion to $3.1 billion, down 21%. Net profit is down 17%, it's $2.4 billion. Their earnings per share is $8.56, down from $9.69. They're giving $1.47 out in dividends. That's $1.47 per share. They bought back a lot of shares. It was $295 million, now it's $277 million. Let's look at a statement of cash flows. That's a lot better. They have positive operating cash flow, $944 million. This is for the trailing 6 months. Last year was negative. The big difference was $2 billion in receivables. Last year was negative $4.4 billion, now it's negative $2.4 billion. In their investing section, they had a cash outflow of $1.7 billion. They provide loans and leases when people buy products, so they had a cash inflow of $14 billion from their financing portion, and a cash outflow of $14 billion. $700 million of PP&E. They added $10 billion of debt. They paid down $8.1 billion of debt. They bought back $2.4 billion of stock. Last year, $2.5 billion, and they paid out $800 million of dividends. The cash at the end of the accounting period is $5.727 billion. Let's look at a company on Simply Wall Street. Its last price, $375, $103 billion market cap, down 1% in the past week, down 7% in the past year. They started trading in 1990, and it was around $10 a share. It ran up to 90 in 2008. Then it was cut in half during the Great Recession. It ran up to 160 right before COVID. Then it bottomed out at 115. Its peak was 446 at the end of 2022. And it's been trading up and down since then. Simply Wall Street's valuation is 367. They say they're 2% overvalued. 23 analysts priced this stock at 423. Their free cash flow forecast for this year is $5.3 billion, next year $6.4 billion, after that $6.9 billion. The red line is their debt, the blue line is their equity. Their debt is always higher than their equity by a decent amount. Currently debt of $66 billion, equity of $23 billion. And they have $4 billion of cash on their balance sheet. When we looked at the industry comparison chart, they had a really high debt to equity ratio. Now it makes sense. They're paying their next dividend on August 7th. The ex-dividend date is June 27th. Here's their dividend yield since 2014. Its highest was 3.1% in 2015, and now it's half that at 1.5%. The forecast is 2.1% by 2026. Like most other companies, their CEO's salary jumped a lot from $600,000 to $1.6 million. Total compensation $27 million, tenure as CEO 4.5 years. 70% of the company is owned by institutions, 22% by the general public, and 7% by VC and private equity firms. Vanguard is the biggest shareholder, then Cascade, then BlackRock. Their employee count was 67,000 in 2013, now it's 83,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, Swiss, London Stock Exchange, Wiener Börse, EuroTLX, Mexican Bolsa, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. The company was started by John Deere. John Deere was born in 1804. He moved to Illinois in 1836 to escape bankruptcy in Vermont. He was already an established blacksmith, and he opened a 1,400 square foot store in Grand Detour in 1837. In that village, he did general repairs, but he also manufactured tools such as pitchforks and shovels. What really set him apart was a steel plow he created. It was much different than the others. Most farmers used iron or wooden plows, but those tend to get stuck in the soil. Deere created a highly polished steel surface that allowed the soil to slide easily. By 1849, he was selling 200 plows a month, which was a lot at the time because it took a long time to make a product. They didn't have advanced technology like today. And then his son joined him in 1853, Charles Deere. They were manufacturing plows, wagons, corn planters, and cultivators. By 1857, their sales volume was over 1,100 per month. There was a lot of competition in the early 1900s, but what set this company apart was the production of gasoline tractors. In 1912, the company had a new president, William Butterworth. William was a son-in-law of Charles Deere. Because Charles died in 1907, that's why William took over. And Butterworth expanded the company into the tractor business. And in order to expand that part of the business, they acquired Waterloo Gasoline Engine Company in 1918. And that company manufactured the popular Waterloo Boy tractor. In 1927, the company produced its first combine harvester. During the Second World War, the great-grandson of John Deere, Charles Deere Wyman, was president of the company, but he accepted a commission as colonel in the US Army. Burton Peake was hired as president during this period. In addition to farm machinery, the company manufactured military tractors. They also made aircraft parts, ammunition, and mobile laundry units to support the war effort. In 1956, Deere & Company bought out the German tractor manufacturer Heinrich Lanz AG. In 1958, the company built a factory in Argentina. Over the decades, the company has built itself to the largest agriculture machinery company in the world. The logo of the leaping deer has been used by this company for over 155 years. In 2017, they acquired Blue River Technology, which is based in Sunnyvale, California. And with this company, they're applying machine learning to agriculture. Blue River has designed and integrated computer vision and machine learning technology that enables growers to reduce the use of herbicides by spraying only where weeds are present. In January 2022, the company introduced a self-driving tractor at the annual Consumer Electronics Show. That's designed for large-scale farming as opposed to existing comparable tractors designed for small-scale agriculture. The company doesn't just sell tractors, attachments, combine harvesters, cotton pickers, seed drills, field sprayers, telescopic handlers. It also sells a lot of construction equipment, excavators, loaders, backhoes, graders, as well as forestry equipment, harvesters, forwarders, skidders. They have a line of lawn mowers, diesel engines, compact utility tractors. And this company has factories in Illinois, South Dakota, Iowa, Louisiana, Wisconsin, Georgia, also in Tennessee, Kansas, India, Germany, Finland, the Netherlands. One of their acquisitions I'm excited about is Bear Flag Robotics. They make autonomous agricultural equipment. They did have a division, John Deere Renewables, their wind energy plant manufacturing arm. That division did complete 36 projects in 8 US states, but was sold to Exelon Energy in 2010. Exelon's ticker is EXC. Their market cap is $35 billion. They pay a 4% dividend. They're a utility company based in Chicago, Illinois. Deere had 67,000 employees in 2013. They laid off 8,000 that year, so it was a little over 59,000 employees by 2014. But their employee count grew to 74,000 by 2019. They laid off 4,000 in 2020, so it was down to 70,000. But it's been growing since then. Now it's well over 80,000. About 44% of their revenue is in the production and precision agriculture segment. 24% in construction and forestry, 23% in small agriculture and turf, 8% in financial services. And a little more than half their revenue is in the US. They do a lot of sponsorships. They have the John Deere Classic, a major golf tournament. They also sponsor NASCAR, and they used to sponsor the NHL team Carolina Hurricanes. So that's the end of the video. Let me know what you think. Thanks for watching.